Hi everybody. In the previous study guide video, we recorded journal entries for the first 4 transactions shown on this exercise. In this video, we'll finish writing the journal entries starting with the October 8th transaction. On October 8th, 20X1, the company completed a $4,500 consulting project for XYZ client and immediately received $2,000. XYZ will remit the balance within 15 days. This is a compound journal entry. It requires that you debit and credit 3 different accounts. Please use your chart of accounts, write the journal entry, and then start the video again to check your work. Well, in this transaction, the company completed $4,500 worth of consulting revenue. So we're going to credit consulting revenue account 403 for $4,500. They received some of that money up front in cash. So we're going to debit account 101 cash for $2,000. And the difference, $2,500, will be received from the company, the customer, at a later date. So we're going to debit account 106, accounts receivable. And here's what it looks like. Debit 101 for $2,000. Debit 106 for $2,500. And credit 403 for $4,500. I'm going to have you finish writing journal entries 6 through 12. So stop the video, record your journal entries for the October 15th through the 12th journal entry on December 5th. Then start the video again to check your work. So here are the solutions. I'll page down and you can check your work very quickly. Then I'm going to go back and talk about each one. So on October 15th, the company paid the full balance due on the purchase of supplies and equipment shown in transaction number 2 above. Well, if you page up to number 2, we incurred a liability of $7,800 for the equipment and the supplies. Now we're paying this off. So we're going to debit account 201 and we're going to credit cash. Debit 201, credit 101 for $7,800. On October 18th, we purchased merchandise for $37,400 on account. We need to debit the merchandise inventory account, account 131, and we're not using cash right now. We're going to pay for it later, so we need to credit the liability account, accounts payable, account number 201. Debit 131, $37,400. Credit 201, $37,400. On October 12th, we received the balance due from ABC customer for services provided in transaction number 3 above. Page up to transaction number 3. The customer owes us $9,300. So we're going to credit accounts receivable and debit cash because we're receiving the cash. Debit 101, $9,300. Credit 106, $9,300. On October 23rd, we received the balance due from XYZ customer for the services provided in number 5 above. In number 5, the customer owed us $2,500. So we're going to debit cash and credit accounts receivable for $2,500. Debit 101, $2,500. Credit 106, $2,500. On November 1st, we loaned $30,000 to an employee. The note is to be fully repaid on May 1st, 20X2, with interest at 12%. Again, it's important to remember that on November 1st, the employee did not owe us any interest on that $30,000. Interest accumulates on a day-by-day basis throughout the time period that the employee has our money. So on November 1st, all we need to do is to record the note receivable for $30,000 and the fact that we wrote the check to the employee, so the reduction of cash, $30,000, credit to cash. We will use this 12% interest information when we do our adjusting journal entries, but not on November 1st. So looking at our chart of accounts, notes receivable, 151, and cash, of course, is 101. So the journal entry is a debit to account 151, $30,000, and credit to cash 101 for $30,000. On November 18th, we received $2,400 from a client for a consulting job that will be performed later. Revenue recognition principle, in its most simplest form, says you record the revenue when it has been earned. If we're doing services, providing services, the revenue is not earned until the job is complete. Well, as of November 18th, we haven't even started that job, so we do not have earned income, we have unearned income. In Accounting 301, we use the terminology a liability for unearned income. In this class, it's the same concept. The terminology is slightly different. We talk about deferred income. So for this journal entry, we received the money from the customer on October 18th. So we debit cash 101 for $2,400, and we credit the liability account deferred income, account 236, deferred revenue, for $2,400. So debit 101, credit 236 for $2,400. And in the last transaction, received the November utility bill in the amount of $900 on December 5th. And we immediately wrote a check in the amount of $900 to pay the bill. So we need to debit utilities expense and credit cash for $900. Utilities expenses account 690. So debit account 690 for $900 and credit account 101 cash for $900. Well, that's all for this video. In the next video, we'll write the company's adjusting journal entries. See you next time.